I've been buying VICI Properties nearly every single day, and in today's episode I'm going to explain why this is my favourite REIT, why I believe in this in the long term. We're going to look at the historical performance of VICI Properties. We'll see, based on their latest earnings, how their top line income statement as well as their bottom line net income has performed. We'll have a quick health check of the company, total cash versus total debt. We'll also see how they perform versus some of their competitors over the last 5 years. We'll have a quick look to see whether or not any insiders have been buying or selling. We'll take a look at their dividend safety, looking at their financial metrics, which ones I like, which ones I would advise to keep an eye on. And we'll also take a look to see what the institutions have been doing in the most recent quarter. And we'll have a very brief look at their latest investor presentation in 2024. And we will also run it through our valuation model, getting to our intrinsic value and our acceptable buy price given our investor margin of safety, and we'll see what Wall Street are forecasting as a price target over the next 12 months. So let's jump straight into the episode, and we can see over the last year they have been down around 8%. They are trading in the mid to lower end of the 52-week range with a yield of around 5.5%, and we can see the forward P to FFO around 12.81. Now, if you've been holding this company over the last 5 years, you would see you would be up around 46%. Bearing in mind it doesn't include those dividends reinvested, and we can see its highs in the summer of 2022 at around $36. So let's take a look at this company. Now, in terms of their income statement, top line revenue, what we like to see for REITs, 5 to 10% growth year on year. December 2018, 900 million on the top line. December 22, 2.7 billion. So we can see some strong growth over the last 5 years. Based on the trailing 12 months for December 2023, the annual report hasn't been released yet, but they are expecting another huge jump to around 3.5 billion. One thing to note, on a more granular level, the top line remained fairly flat from 18 to 19. And then from that point on, we saw some nice consistent increases. So very positive to note, and we will shortly look at the last 5 to 10 years percentage-wise. Now, in terms of their bottom line, how does that compare? Well, it's gone from 524 million in 2018 to around 1.1 billion. So essentially doubled their bottom line over the last 5 years. And we can see they're expecting to double it from 2022 to 2023 to around 2.4 billion. And something else to note, we do see those increases on the bottom line year on year. So both top line and bottom line have been increasing over the last 5 years. That is very positive to note for any company that you do look to invest in. Cash and cash equivalents, quick health check. Well, it's gone from 580 million in 2018 to around 510 in their latest quarterly report. So VICI Properties, their cash has reduced by around 10%. Now, in terms of comparing that to their total debt numerically and directionally, we can see it has gone from around 4.1 billion in 2018 to around 17.5 billion. So in fact, their total debt has increased quite significantly, more than 4 times. And whilst this is typical in the REIT industry, taking on more debt, we will take a look at that in our financial metrics. Very quickly then, how has their performance been versus some others in the other specialised REIT industry? We have Iron Mountain, Gaming and Leisure Properties, as well as a few others. So we can see over the last year, VICI Properties has been in the middle of the performers. We can see with a minus 3% return. That does include those dividends reinvested. Now, when we expand that to the last 5 years, VICI Properties is up with those dividends reinvested 92%, one of the best performing, just behind Iron Mountain at 156%. But as always, I do always say past performance is never an indicator of future performance, but it is nice just to see that they have performed well on a total return basis over the last 5 years. In terms of insider buying and selling, well, we can see here VICI Properties within the last year, in fact, there has been no insider buying or no insider selling, so something just to note there. Institutional ownership, 97%, as we can see here, around 2 billion worth of sales over the last 12 months, and we can see over the same time period just under double in terms of buyers at 4 billion. And when we look from 2023, every quarter, Q1, Q2 and Q3, we can see more buying than selling. And Q4 we see the same, although less as much as the previous quarters. Again, with institutional buyers, we shouldn't be copying what they're doing. We should always be doing our own due diligence and our own analysis. So now jumping into their investor presentation, just a few things to note. Now these are the years that have gone by. We can see the EBITDA, earnings before interest, tax, depreciation, amortization, year on year. It is increasing, which is very positive to see. So this is still a very strong growing company. And for those that don't know, they have around 54 gaming properties, 38 family entertainment centers with around 12 tenants. Now, when we take a look at that a little bit more detail, we can see their tenants listed here. Now, just a few things I want to point out from this. WALT, for those that don't know, refers to the weighted average lease term, which means their biggest properties, in fact, Caesars Resort as well as MGM, they hold around 74% of the annualized cash rent. Both of those on average around 40 years before the lease needs to be renewed, which is very positive. They are locked into very long lease terms, and that is pretty much the same with the rest of the tenants. In fact, on average, it is around 41.5 years. And what we can see here is 100% triple net lease. So all the expenses and all the maintenance upkeep is passed on to the tenants, which is very positive to note. Moving on to some more information, which I think is quite key to point out here. In 2020, when we had the global pandemic, when a lot of these hotels were shut down, when Vegas was more than likely to be a ghost town, they did pick up 100% of that rent. And we can see it is typical to see around 70 to 99%. So it is positive to see, as well as in the industry in terms of the lease terms that we just ran through. It is around 8 to 11 years on average, and we can see here for VICI Properties it sits around 42 years. Barriers to entry as well, very positive to note. It is high as opposed to other triple net lease where it is low, so it is very hard for other companies to try and gain a lot of that market share that VICI Properties do hold as well, so very self-explanatory there. And we can see around 96% of these tenants of the annualized rent are long-term CPI protected rent rolls. So if CPI does increase year on year, so do their rent. So lots of positives to note here. And just a few other things from this investor presentation that I do want to point out, which I think is quite important. Their annualized VICI cash dividend per share has grown, as we can see, 7.6% CAGR, compounded annual growth rate. So that is very positive. And when we compare that to some other REIT favorites, we have ADC 6.2%. We have Realty Income 3%, as well as Triple N at 2.5%. So it is a very strong dividend CAGR over the period. So just a few things that I do quite like. We will touch upon these in the financial metrics. We can see, for those that did want to see where their properties are, the locations in the USA. They do also have some, not just in Vegas, as that is a lot of their most popular ones that a lot of people do know. And for those that want to see those different multiple retail and revenue streams, we can see the hotel rooms, the gaming properties, gaming spaces, food and beverage outlets as well, and retail outlets. So it is looking very strong for VICI Properties. Now let's jump into the dividend safety. Now the score is sitting at 50, borderline safe. We'll touch upon why that is shortly. Market cap 32 billion. It is a large cap company. And when we took a look at those recessionary metrics, well, unfortunately, this company wasn't formed in this period, so we have no comparative data. Latest increase 6.4%, which is very strong, above that minimum 4% we always advocate on the channel. And you are locking in a pretty decent 5.5% starting yield as well. So that is a lot of benefits for those that do like high yielders without compromising on dividend growth. And they have increased those dividends for the last 4 years. Now, dividend yield theory states the company is undervalued when the current yield sits above the 5-year average. So we have our sign of undervaluation, 5.43 versus 5.03. Likewise, forward P to FFO, 13.8 versus 14.8. So we have a double sign of undervaluation, but do bear in mind we're not looking at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. Real estate sector P to FO is pretty much in line as well, 13.9 versus VICI's 13.8. In terms of looking at the free cash flow payout, which we typically do for REITs, it is a lot more volatile. So we do focus on the adjusted FFO, funds from operation. Below 75% is our target for hotel REITs. Nice to see that whilst it has straddled along that 75%, 2023 and 2024 are expected to be bang in line at 75%. So we should see another nice high single-digit increase from VICI Properties this September. Adjusted FFO as well, nice to see that consistent growth year on year. 2023 and 2024 expected to be more of the same. Now sales growth, remember 5 to 10% is what we like to see. The last 3 years, very, very strong double-digit growth. 2023 expected more of the same, 54% to that top line. And we can see that numerically from around 200 million in 2017 to 3.47 billion expected in 2023. Now, shares outstanding, as we always say with REITs, it is very typical for them to dilute your position over time. The reason for this is they issue equity to fund property acquisitions as they retain little of that internally generated cash flow after paying the dividends. So you can see they do dilute your position at a fairly fast rate. Do check out the other REITs we check on the channel and analyze so you can see a comparison. ROIC though, very strong. We do typically say for REITs 3 to 5% to give us faith that management are able to effectively allocate their capital. 2023 at 8% is very strong, and it's not the first year it's been at 8%, so that does give us a lot of faith when considering management in our investment thesis. Operating margin as well, very nice to see. 2023 91%, and this isn't the first time we've seen it in the 90s as well. So overall, very, very effective and efficient. Now, net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us two things: dividend safety as well as that balance sheet strength. We're looking for a maximum of 3.5, which these are the number of years it would take the company to pay off all of their debt net of cash on hand. Bear in mind now, 6.46 is very high in 2022. The only positive to say is 2023 and expected 2024 is expected to come lower. So that does give us faith that that dividend should be safe for now. But it is something that personally, as an investor, I am keeping my eye on. I would like this to come down to around that 3.5 over the next few years. Now, before we jump into the valuation, just to let you know, I am sending out a free weekly newsletter, so do click on that pinned comment below if you want to sign up. It's completely free, and we'll be discussing a lot of different things in investing. We're going to be looking at 7 golden dividend metrics I use to analyze stocks. We're going to be running through stocks on the watch list, and we'll talk about stocks we've analyzed on the channel, their margins of safety, and have a lot of information. Now let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And as we run through the valuation model, if you do want to grab a copy to get to the intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. Now for REITs, Graham's valuation isn't applicable, so we won't be using this one. So the first one will be the REIT multiple valuation model. We have companies in a similar sector and size: Iron Mountain, Gaming and Leisure, Lamar Advertising, which we ran through. Using the average P to FFO and that of VICI, we get an intrinsic value of $31.53. Our first sign of undervaluation, but bear in mind we don't look at any of these models in isolation and we'll draw conclusions towards the end. We then have the dividend discount model with the yearly dividends. Growth rate looking very nice, 7.9%. Forward looking, I've gone a lot more conservative. As always, if you do grab a copy of the model, you can play around with these percentages. And therefore we have our second sign of undervaluation. We then have the DCF model with the average growth rate, forward growth rate per analyst estimates in conjunction with the discount rate. We get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, arrive at the equity value. Divided by shares outstanding, we get an intrinsic value based on the DCF model of $37. As always, the intrinsic value is just the average of these models, and it comes for today's episode of VICI Properties at $37. Margin of safety then, I would typically say 10% is what you'd use if you believe it has a wide moat, strong financial metrics, good forward-looking data. And it is a buy at 15%. At 15%, we do see $31.85. At 20%, you would be waiting at around that $30 mark. Now, personally, for me, this is one that I do believe to be a buy over the longer term. I am looking out over the next 10 to 20 years. And based on the information we have on their investor presentation, there are a lot of positives to be excited for VICI Properties. It is impossible to time the market now, whether or not you're looking for a specific price. The market is anticipating rate cuts in 2024, which I do believe will help VICI Properties significantly. If you've watched one of our earlier episodes, we do run through a lot of the data which does say that when they do cut the rates, REITs are very, very strong performers in comparison to other companies in the market. In terms of Wall Street and what they forecast, well, they see around 17% upside over the next 12 months, and they have a price target of $36. As always, do let me know your thoughts in the comments below. Is VICI Properties one you have been looking to add or one you have been buying? And if you are bearish on the sector, then as always, give us your thoughts and comments. Have a great day. Catch you all on the next episode. Don't forget to smash that like button and see you later.